Hello, real estate investors and future real estate investors. Today I want to go over real estate versus stocks for early retirement. Now, these concepts I want to cover will also work for traditional retirement at 65 and 67 as well. If you notice the name of my channel, you probably think I'm heavily biased towards real estate, and I do love real estate, but in my own personal portfolio, I have about a 50-50 mix of real estate and stocks. I think stocks are a great way to build a lot of wealth over a long period of time, but also really believe you need a healthy amount of real estate in your portfolio as well. And that's what I'm going to cover today. Before I dive in this, let me just give you my background. I've been investing in real estate since 2008. I currently have 31 rental units all the way from single families up to my largest multifamily is 12 units. And real estate and a combination of stock investing allowed me to retire from my corporate job, retire because I still work on my, in quotes, because I still work on my rentals. But a few years ago at the age of 48. And so the last couple of years, I've just been managing my rentals and doing things to help other real estate investors, such as making this video. So if you like this kind of content, consider subscribing because it really helps keep me motivated to continue to make these videos. So with that, let's dive in. So the first reason I think you need to have some real estate in your portfolio is cash flow. Now when you retire from your job, unless you have a pension or something else, you need to basically generate your own paycheck. And real estate's a great way to generate cash flow. In the area where I invest, in the Midwest, I buy B and C class rentals. If you don't know what class is, I have a video on that you can watch. I buy B and C class rentals in the Midwest, and the returns I expect to get in my area, this is going to vary by area, is 10% on a cash purchase, on an all cash purchase, and 20% on a financed or leveraged purchase. So what this means is if I buy a $100,000 house, after all expenses, a $100,000 house and I pay all cash, after all expenses, I would expect to make $10,000 a year of real cash that I can live on. If I leverage that same $100,000 house and say I put $20,000 on it, I would expect to make 20% on my $20,000 down payment, or $4,000 after all property expenses and debt service. Every year have $4,000 actual cash that I can take out and use for my living expenses. So that's real estate. What about stocks? One of the big misconceptions is that the stock market goes up 10 to 12% annually on average. So I should be able to withdraw 8% a year, right? It goes up 10 to 12%, why can't I withdraw 8? And you really can't. And there was a study done by Trinity University back in the 90s. And what they did, they looked at what kind of withdrawal rates can I take out each year that will safely last me 30 years in retirement. And they defined the retirement period as 30 years. So I'm not going to go through this in detail. Just Google Trinity Study, there's all kinds of videos on it. But basically, they did a back test of every 30-year period in the history of the market to test what kind of withdrawal rate you could pull out and have some reasonable guarantee that your money is going to last 30 years. And the number they came up with was 4%. So basically, any period in history, you could start the first year by taking 4% of your portfolio out, and every year adjust that number by inflation. And most likely, your money will last a full 30 years without running out of money. So what does this mean? Let's go through a couple of examples to see the difference in cash flow. So if I made 20%, if I had 20%, 10%, and 4%, this is real estate, and this is stocks. So if I needed 40K a year to live on, let's say, so if I'm getting 20% return, I could invest 200K in real estate, and that would generate my 40,000 a year I need to live on. At 10% return, I'd have to invest 400K, and at 4% return to generate 40,000 a year, I need to invest in even 1 million. Now, if you need more out, we can run through another example. Let's say I need 100K a year to live on comfortably and cover all my expenses. At 20%, you would need 500K invested, 1 million here, And at 4% to generate 100K in income, you need a whopping 2.5 million. So as you can see, one thing nice about having real estate in your portfolio is that you could get to your number much sooner, much easier, with a lot less money, and so that could help you retire a lot earlier. Now, what if you say, I don't really believe in this Trinity study. I heard on the radio some guy tell me that I can pull, because the market goes up 10 to 12%, I can pull out 8% a year safely. And that would be true if the market went like this. And this is supposed to be a straight line. If every year, just bang, 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 10%, 12% every year, it went up. But that's not what the market actually does. It actually does stuff like this. That's not a perfect drawing, but anyhow, this is year 2000. This is year around 2008. So if you, let's say you had a $1 million portfolio in stock, and you said, I'm going to pull out 8%, or 80K annually, and then adjust that for inflation, just like the 4% rule, but with 8%. Problem is sequential return risk, and that means early in your retirement, if the market substantially underperforms the normal return, that you could run out of money. So in this example, if you were unfortunate enough to retire in the year 2000, the market's gone down, this went down roughly 40, 50%, same thing here. But you're every year, as the market's gone down, you're drawing $80,000 out. Obviously, you can see your money's not going to last if you're doing that. And actually, Monthly Fool did a study and said if you took out 8% starting, and you retired in 2000 and took out 8% a year, by 2009, you are broke. So a whopping 9 years in the retirement, about right in here, you went broke. Right? That's scary. You don't want to do that. So that is why you cannot take that much out. Although the average return of that of the market is 10 to 12%. But if you're taking that out and you happen to retire at a very bad period of time, you could actually run out of money fairly soon. In this case, in this example, in 9 years. But you say, well, but real estate got hammered during the financial crisis, right? So that's no better. And that's kind of true if you were selling, but this is going to lead to my second point, is stability. And it is true, real estate, if you were selling real estate or flipping real estate, you got hammered in 2008, 9, 10. But if you already had existing rentals, what really matters is what did rents do during that period? So this is a graph, a rough graph of rent prices in the US, what happened over history. And here's what happened. So rent prices just continue to go up. In 2010, roughly, there was this period where they were relatively flat, but then they just continued to go up. Now I'm going to argue that during that period, this was probably your high-end A-class rentals that didn't go up. In my area, we didn't see a decrease or even a flattening of rental prices here in the Midwest where I'm at, anyhow. And as far as vacancy, so rents continue to go up. What about vacancy? Well, vacancy overall in the U.S. did increase a couple percentage points. But I'm going to argue again that was in the high-cost areas with A-class properties, very expensive A-class properties. Because what happens during a recession? People that would normally buy a house, now they can't get financing, right? So now they're looking to rent. Or people that got foreclosed on, they've got to have a place to live, right? So they're looking at B and C class rentals. So when you're on that lower end, there's always people coming down the scale, right? When there's a recession, there's people coming up as well, but there's a large group coming down that are looking for rentals. So definitely in my area, I didn't see any decrease in rent prices, and I didn't see any vacancy increase. But on the coast, with probably high-end rentals, that's probably where they saw any change at all. But overall, total U.S., Rent prices just flattened slightly and continued to climb during the financial crisis and after. So the third item, why I think you need some real estate in your portfolio, is control. So if the market's going bad, we're in a recession, there's nothing I can really do to help Amazon or Coke or McDonald's or any of these big companies, right? With my real estate business that I have some control over that. So I can control how much work I outsource, what capital improvement projects I do, different things like that. Whether I have a property manager or I manage it myself. So a great example is during the start of the pandemic this year. I didn't know exactly what was going to happen. So I planned to put a couple of roofs on the houses and replace a couple of decks. I stopped all that. Until I had more clarity, I wasn't going to replace any roofs or have any major expenses, just patch them and get through. I was able to do that because I have some control to control my cash flow. I can't do that for companies, large companies, or for stocks. So I think that is another great element. You can control when you spend, and you can control what you do yourself if times really got tough in business. So that's the three main reasons. There's many, many more. Taxes are one. It's so complicated, I didn't want to tackle that. But there's other reasons as well that I think you should have real estate in your portfolio. So I hope you got something out of this. And if you have any questions or comments, please leave them below. I appreciate you watching.